Hey, what's up everyone? My name is Ale. Welcome back to my world of stocks. In today's video, we're going to be talking about Steve Cohen, who is not only famous for owning the New York Mets baseball team, but he is also one of the richest and most popular hedge fund managers and investors of our lifetime, with his investment firm Point72 Asset Management currently holding over $26 billion of assets under management. So you can bet that when Steve goes out there and makes moves in the market, there's a lot of people paying attention to that. Well, in today's video, we're going to be taking a look at the most recently released regulatory filing, because what I found there is that Steve actually went out in the most recently reported quarter and he spent billions of dollars to more than double down on several different stocks in the market. And so in today's video, I'm going to run down for you guys the 5 biggest purchases of those, and I'll give you my personal opinion on each one of those stocks, and I'll even rank them from best to worst just to make the video even more fun and interesting. So I hope you guys enjoyed. I love making these review video for you guys. Let me know if there's any other investor or someone you want me to take a look at their portfolio for a future video. But with that said, let's just go ahead and jump straight into this list for today's video. 5 stocks that Steve Cohen is more than doubling down on. All right, and let's start first here with the smallest overall position, and then we'll work our way up into the largest. And so first up here, it's going to be the ride-hailing and delivery company Uber, ticker symbol UBER, which Steve didn't just double down on his position, he actually increased it by close to 2,000% in the most recently reported quarter, bringing his total stake in the company up to almost $250 million. Now, Uber is very interesting because it's still highly speculative, as they lose billions of dollars every year, with last year in particular actually being the worst one in history at a record-breaking $9 billion loss on the bottom line. And yet investors continue to pour money into the company with a market cap of over $61 billion. So why is that? Well, in my opinion, I actually think most investors in Uber are more so betting on the company's future potential with autonomous driving rather than the current state of the business. See, Uber's biggest expense by far is how much they have to pay their drivers, but once autonomous driving kicks in, Uber will have very little expenses with higher software-like margins because they won't be having to pay those drivers. Now, granted, Uber isn't just a ride-hailing business anymore. They've also expanded into other markets like food delivery with Uber Eats or even logistics with Uber Freight. But again, I think that their business model is at least somewhat dependent on an autonomous driving future. And don't get me wrong, I definitely think that that's a future that we're heading towards. And Uber themselves are already testing out a robotaxi service out in Vegas that they plan to expand into other parts of the country over time. And meanwhile, this stock has already lost about half its value, leaving them with a pretty low price to sales ratio of less than 2, which is not too bad for a high growth spec stock. However, the problem I have with Uber is that their growth is actually not as high as you might think right now, with sales only expected to climb by around 15 to 20% in each of the next 2 years. That's not bad, but it's also not very good for a still unprofitable spec stock. Now, to be fair, a big part of the low growth is probably because of the horrible economy right now, but you could also argue that picking up an unprofitable spec stock in this tough environment is also pretty risky. And for me, personally, I already have tons of exposure to the future of autonomous driving through Tesla, Nvidia, Baidu, and even the smaller spec stock NIO. So why would I wait around for Uber when I already own all of those stocks, which I actually consider to be much safer? I understand why others might want to bet on Uber as a small spec stock in their portfolio, but it's definitely not one that I have any interest in owning myself, so I'll have to rank them pretty low here at number 4 until I see what else is on this list. Alright, moving on to the next one here, we actually have a stock that, by contrast, I am actually in love with, and that is the e-commerce and cloud computing giant Amazon, ticker symbol AMZN, which Steve close to tripled his position on in the quarter, raising it by about 175%, bringing his total stake in the company up to over $400 million. And yeah, what's not to like here? Not only does Amazon command the most e-commerce market share at around half the entire US market, market. Not only are they by far the largest cloud company in the world, not only are they slowly becoming a gigantic threat to Google and Meta in the digital advertising space, and not only are they investing in new growth opportunities like video streaming and electric vehicles and more, but despite all that, Amazon stock is actually crumbling, going through one of the biggest drops that I've ever seen in it after recently becoming the first company in history to lose more than $1 trillion of value. And you know what, guys? I actually fully expect Amazon to get all of that value right back and much more over the long term. I don't even need to talk about this one any further. They easily get the number one spot because I believe it's a no-brainer for almost anyone's portfolio. By the way, they have the same price to sales ratio as Uber. How crazy is that? All right, moving on to the next stock on the list at number 3 here, we actually have a really interesting one that I don't think I've ever talked about on the channel before, and that is Salesforce, ticker symbol CRM, which is technically a new position for Steve at close to $500 million, but if you actually look at the history of it, Steve had recently sold out of the stock before now buying back in, and that old position was around 488,000 shares, while the new one is over 3.3 billion shares. So that's a giant increase of more than 7 times the size. Anyway, Salesforce is one of the original software as a service providers, which allows users to access their platform and services from anywhere in the world as long as you have an internet connection. And what they do is basically they help businesses run a multitude of different apps and services, but primarily they're known for their expertise in customer service solutions as well as sales and digital marketing, especially automated services that reduce costs and increase sales by close to 30% each for their clients on average. And the formula has resulted in a lot of success for them, sending their revenues soaring in recent years. However, the deteriorating economy is finally starting to take a toll on them as profits have now plummeted into the ground, while their revenue growth is only fetching a very low double-digit percentage going forward. Now, that's not very high, I would say, for a stock that is already trading at a price-to-sales ratio above 5 and a forward PE above 30. Even with the stock down close to 40%, that's still a pretty, fairly expensive valuation. It's not all bad though, and actually the stock could be seen as somewhat of a decent value over the longer term if you're looking out into a longer horizon, as their 5-year price to earnings to growth ratio is actually cheaper than the sector, which is due to their profits actually growing by an average of close to 20% expected over the next 5 years, thanks in large part to those, again, software-like margins that come from their software as a service, infrastructure or structure. So I definitely still like it a lot more than Uber, but I also feel that it's a bit too speculative and risky for my own personal portfolio, so I'm going to put them just slightly ahead of Uber at number 3 for now until we look at these last 2 stocks on the list. Speaking of which, coming in at the second to last stock, it's actually going to be one that I do really like myself, and I actually own a few shares of it too, and that is Broadcom, ticker symbol AVGO, which Steve more than doubled down his position on after increasing it by 165% in the last quarter, bringing his total stake in the company up to almost $500 million. And as you may know, Broadcom is a semiconductor specialist that develops custom chips for other companies that are used for all sorts of different applications, like just raw processing, or used for data centers, or used for storage, or even networking and internet connectivity, all sorts of different things. And their biggest customer, for example, is actually Apple, who uses several of their chips for their various products. They've also been expanding heavily into software services too, though, especially through acquisitions like the one that they made in CA Technologies for close to $20 billion, as well as a more recent bid for cloud software specialist VMware that is worth over $60 billion, making it one of the biggest tech deals in history, although they are still fighting for regulatory approval on that one. Regardless, Broadcom is a giant force to be reckoned with that continues to put up impressive financials on both the top and bottom line. And while growth is slowing down right now, coming off of the explosive growth that they saw during the pandemic, as well as having to deal with a very tough macroeconomy right now, the fact is that they're still managing to put up around a double-digit growth rate on their EPS numbers going forward, which is very impressive in this environment. And that strong performance is also the reason why their valuation is about 30% cheaper than the sector on a PEG ratio basis. And that's despite the stock actually trading near an all-time high as well. Plus, you get one of the absolute best growth-oriented dividends out there with already about a 3% yield, yet it still has a great payout ratio below 50%, a gigantic growth rate of over 25%, and a double-digit growth history of 13 years in a row. Broadcom is not the absolute cheapest, nor is it the most attractive stock in the market, but what it is a pretty solid all-around dividend growth stock that can fit nicely into, I would say, most people's portfolios, and that's especially if they're thinking for the long term. And so because of that, I'm actually going to rank them fairly high here. I'm going to put them at number 2 for now, only behind Amazon on the list. All right, everyone, that's going to leave us now with the final largest purchase that Steve made most recently. And that's actually going to be another very solid pickup here that I also own myself in the Facebook and Instagram parent company Meta, ticker symbol META, which Steve more than doubled down on his position after increasing it by over 140% last quarter, bringing his total stake in the company up to over $500 million. And like the others, I very much like this one too. Meta stock has, of course, gone through some huge volatility over the past few years because of their controversial investments into the metaverse that have costed them billions of dollars. In fact, throughout last year, they actually spent an average of more than $1 billion per month, which is pretty crazy to think about. And now they're trying to recoup those losses by laying off 11,000 workers last November and another 10,000 announced last month too. Because of all this, the stock has been super volatile, completely crumbling into the ground last year, which is where I also bought much heavier into the stock myself too. But soon after that, it suddenly skyrocketed by almost 80% this year. And given that sudden sharp rise, it's probably safe to assume that Steve won't be buying any more shares at this time. In fact, I wouldn't even be surprised if he's selling some of the stock now. However, I'm personally holding on to my shares for the long term regardless, and that's because of a couple different reasons. First of all, Meta is still down close to half its value from the top and trading right near pre-pandemic levels despite their sales actually skyrocketing by close to $50 billion just during the pandemic years alone. This is because more people have turned to social media, leaving their user base at close to half the entire world's population, which is mind-blowing to think about. And it's also close to 80% of all internet users using at least one of their apps as well, which is also pretty crazy. And yet going forward, there's still a lot to be optimistic about, like the fact that analysts predict a return to double-digit revenue growth next year despite their already massive size. And over the very long term, if the metaverse turns out to be even a fraction of the size that experts are predicting it'll be, which is usually valued in the trillions of dollars with a T, well, at least we know that Meta will be one of those leaders of that market thanks to their huge investments in it. And their already massive user base is something that they can really tap into for the metaverse as well. So that bodes very well for them too. They have like the perfect structure to go after it. So at a valuation that is about the same as the sector on a PEG ratio basis, I just think Meta is still a pretty good value overall for the long term. It's a little hard to rank it here because I do feel that Broadcom is a decent option as well, and they both kind of have their advantages and disadvantages over the other. But I just feel like I have to put Meta ahead of Broadcom at number 2 just because of their massive size alone. So I'll push the other ones down one spot to fit it in. But there you have it, guys. I would say some pretty decent stocks here that I do kind of like. I review a lot of different portfolios or different purchases that investors are making. This is one of the ones that I think I like quite a bit, at least the top 3 of the stocks. And I went ahead and ranked these as the following. I put Amazon at number 1. I just think that's a no-brainer. I put Meta at number 2 for the massive size and future metaverse potential. Broadcom at number 3. I think it's a solid all-around dividend growth stock. Salesforce at number 4. I kind of like them, but it's a little riskier than others. I'm not interested in it. And then Uber at number 5. I have like no interest at all in that one. I think there's much better plays for the robotaxi market out there. But those are just my thoughts, everyone. What do you all think? I'd love to hear your thoughts. Do you agree with my rankings here? Do you disagree? Would you make any changes to it? And again, let me know if there's any other investor or hedge fund manager, rich person you want me to take a look at their portfolio. I'd be happy to do that for you, or look at stocks they're buying or whatever else. But anyway, thank you for stopping by, my friends. I really appreciate all the support. It means the world to me. Thank you. I hope you're all doing well. Now we'll catch you in the next video. Take care, everybody. Bye-bye.